How would you value a satellite? Yes, not valuing a company, but valuing a satellite or any other object, a thing, a toy, or even an animal like a cow. Sometimes in finance interviews, especially IB, private equity, and corporate finance, you will get a question that is completely out of syllabus. Interviewers ask this because they want to see if you truly understand first principles of valuation. They want to see your thought process, how you structure your answers, and how you handle a curveball under pressure. So in this video, I am going to show you exactly how to structure and answer this question crisp, clear, the way investment bankers and the private equity analysts actually do it. But before we start, make sure you subscribe. I break down real interview questions and finance concepts like this every week. So whenever you face an unusual valuation question, especially when the interviewer gives you a unique or one of its kind object like satellite, the best thing you can do is slow down and clarify assumptions first. This alone shows them that you are thinking. Here is exactly how I would respond in an interview. I would begin with clarifying revenue generation possibilities from satellite. So, I would ask, does the satellite generate revenue, for example, through selling data, imaging subscriptions, and bandwidth leasing? If the interviewer says yes, great, I know now I can value it using cash flows. So, DCF becomes the primary method. If they say assume whatever you want, then I choose revenue generating because that makes the question analytical. Second, to understand how long it generates cash, I ask what useful life should I assume? Most commercial satellites operate 10 to 15 years depending on fuel and solar degradation. If not specified, I'll assume 15 years. And next, I will ask, when you say unique, is it literally one of its kind or is it part of a broader category like imaging or communication satellites but with some unique characteristics? This tells me whether I can benchmark this satellite against other existing satellites or not. Once you clarify these three things, the interviewer already thinks, all right, this person is structured. Now, before I dive into the details of each evaluation method, I will always lay out the structure upfront. This is extremely important in interviews because interviewers want to see if you can organize your thoughts. And when it comes to valuing a single asset, especially something unique, my thinking is always the same. If it earns cash, I will start with DCF. If there are comparable assets, I will benchmark it against them. And to avoid overvaluing, I will use replacement cost method. So in the interview, I would say something like, given it's a revenue generating satellite with a 15-year of useful life, I would use DCF as a primary valuation method. Cross check it with comparable satellite contracts and set a floor using replacement cost. Now, just to make my logic clear, here is the intuition behind each method. DCF because the satellite generates predictable yearly cash flows. Comparable contracts because governments and other agencies regularly buy satellites so they can act as market benchmarks. Replacement cost because no buyer pays more than what it costs to rebuild the same asset today. In many interviews, just presenting this high level structure is enough, but if they want depth, here is how to expand it. Let's start with DCF. Now, before I walk through the components, let me give you the clean formula upfront because it makes everything that follows much easier to follow. Free cash flow is equal to EBIT into 1 minus tax rate plus depreciation minus any reinvestment, which is maintenance, capex, or change in working capital. Alright, now let me walk through each of these components exactly the way I would explain in an interview. To forecast revenue, I stick to first principles, that is, revenue is equal to volume into price. Volume here could be data sold, images subscription, or bandwidth leases. If you know more about the business model, you can break it down better, but in an interview, keeping it simple is fine. Pricing grows modestly, usually 1 to 3% a year. Next, I will estimate operational expense. So satellites usually have fixed cost, ground station operations, staff expenses, software or any data processing expense, and the station keeping fuel expense. Because these are mostly fixed, as our revenue rises, margins expand. So later year cash flows increase significantly. Depreciation, I will depreciate satellite build costs straight line over 15 years. Depreciation reduces EBIT, reduces tax, and then gets added back because it's a non-cash. Now for capex, I believe it will be just maintenance capex for any upgrades. And for satellites, I assume negligible working capital, no real inventory payables or receivables. So our free cash flow becomes EBIT into 1 minus tax rate, depreciation, maintenance, capex, and change in working capital, which we have assumed 0. And here is the important part. Given that we know satellites do not live forever, it has a useful life. So I don't use a perpetual growth. I forecast these cash flows for 15 years and then calculate the terminal value, which will be a scrap value minus any decommissioning cost. I then discount all yearly free cash flows plus terminal value back to today using an appropriate cost of capital, and this will give me an intrinsic value for a satellite. Next, for benchmarking, I look at comparable contracts. Even if the satellite is unique in its design, governments and space agencies regularly buy satellites, so we have real world pricing to benchmark. So I look at major procurement sources like NASA contracts, ISRO contracts, or any other commercial or government contracts. These give me a market anchored range and help me triangulate against my DCF. Then I look at replacement cost. Basically, how much would it cost to rebuild this satellite today from scratch? If it costs $10 million to design, build, test, launch, insure, and support a new satellite, no rational buyer will pay more than $10 million for an existing one. So replacement cost naturally sets the valuation floor, meaning the minimum value or price. Note here, no need for any technical details. The purpose is just to show you can triangulate the valuation just like we do in any company valuation. So that's exactly how I would value a unique revenue generating satellite in an interview using DCF, comparable, and replacement cost method. This framework works for almost any unusual valuation question like valuing a cow or a toy. And remember, the interviewer is not testing your industry knowledge. They are checking whether you understand valuation fundamentals and whether you stay structured under pressure. If you can answer like this, you will stand out in IB or PE interviews. Now, let me know in the comments, how would you value cow after watching this video? If you like this video, check out my finance interview playlist for more real questions like this. And of course, if you found this helpful, hit like and subscribe. Thank you.